Good morning. Can you believe it's March already? In February, what a month. We had resources up 12%. Bitcoin nearly reached 60,000 after Tesla bought shares. And we had, I'm sure all of you were waiting with bated breath on this past Saturday at 3 p.m. when Warren Buffett's Berkshire Hathaway's annual shareholder letter came out. Always a very good read. And fortunately, we had Charlie Munger commenting on Bitcoin. He was asked when comparing the valuation of Bitcoin and Tesla what he thought, and he said, to quote someone else, "Sir, there is no settling the point of precedency between a louse and a flea." Basically, he doesn't think much of either Tesla or Bitcoin. In fact, he's previously called Bitcoin rat poison, and Warren Buffett has called Bitcoin double rat poison. So there's certainly no love in the Berkshire Hathaway stable for Bitcoin, and they certainly are not buying it. However, they do see value in their own stock, and they had a record buyback over the last year, $24.7 billion worth of shares that they bought back. Quite phenomenal. Anyway, so busy month, lots of market moves. Locally, we had SONA and the budget and a draft release of the Reg 28 changes. Finally, we've been waiting for that since September. It's finally out, and we'll tell you all about that later on. But let's begin with the surveys, as always. The Sygnia funds looking very good over the various timeframes: 1 year, 3 year, 5 years, 7 years, out to 10, across all the risk spectrums from low risk, 40% equity up to high risk, 70% equity, and you can see there across the multi-managers, first in most of the categories compared to peers. So that's looking good. This is just delving into the Signature 70 fund, and there you can see number one across the time frames. And what's also interesting is that the 1 year gap consistently stays about 10% from top to bottom. And the 3 year gap's opening up as well, with that nearly 5% between the top and the bottom. So a lot more dispersion than has been in the past. As you can see, further out, 7 and 10 years, still a lot tighter. And then against the single managers, Sygnia looking good. First over 3, 5, and 7 years, only behind over 1 year compared to Coronation, who are having a fantastic year over the last 12 months. So let's jump into markets. It's still all about the vaccine, except now instead of counting the new daily cases, although we still are doing that, it's about how many vaccines are being administered every day. Fauci says that we need to vaccinate between 70 and 80% of a population to enable a degree of normality. Fortunately, in the US, that's possible within the year. Fauci seems to think that by end of 2021, the US will be over 70% inoculated. However, the rest of the world's not looking so good. And if you take the current daily rate of global vaccinations, we're looking at 4.5, nearly 5 years to achieve that vaccine rollout. Now, as many of you know, from the flu vaccine, a lot of these vaccines only last for 12 months. So if you're taking 5 years to roll out something that lasts 12 months, well, it's going to be quite tricky. So I think that the best solution there is at least to focus on the high risk, the healthcare frontline workers, and that should at least be doable over a 12-month period and reduce the deaths and keep populations that are high risk well protected. But certainly it's not going to be feasible to roll it out to every person on the planet every 12 months. But globally, very exciting to see the new cases dip. The chart on the right there shows you how the daily increase in cases, this is the 7-day moving average, dropped from nearly 1 million a day down to 400,000. That's a lot of new cases. And but good to see how it's dropped off. Now, a lot of analysis has been done into the numbers across various countries, and the statisticians have tried to work out what led to that decrease in cases. They've attributed it to 3 things. Firstly, the lockdown, which certainly helped. the vaccine, which helped in certain countries, and the new variant, which worked against that process. But even if you apply all three of those factors and you look within South Africa, the daily cases should only have fallen by 10%, not by more than 60%. So we really don't understand, we still don't understand how the virus works. It seems to be some sort of burnout. It catches, it just is too contagious, and after 2 months seems to burn itself out, and then you move on for a lull. But I think, although there is likely to be a third and fourth wave, with the vaccines protecting the high risk, markets are certainly looking through this, not expecting to have any major lockdowns happening going forward. We are seeing 241 million doses already administered across 103 countries. So things are looking very good. Yes, risk exists, and there's now a new variant in New York, which is being monitored very closely, but the virus seems to at least not be moving markets at the moment. That risk is certainly mostly behind us. The J&J, Johnson & Johnson vaccine is also finally granted regulatory approval in the US. It's looking very effective after only 1 dose, but still has not received emergency authorization yet. And South Africa is the first country in the world to be administering that vaccine as part of the trial. But generally, the vaccine risk seems to be behind us, and it is certainly a case for being bullish, not bearish at the moment. The US continues to be another very bullish signal. Biden was inaugurated on the 20th of January. On that day, he said, we have to act, and we have to act now. And he certainly has acted incredibly fast. He's been working very hard, but completely opposite to Trump, he's been working very quietly. And there's hardly any noise coming out of his Twitter accounts. He's just there getting things done, being very efficient. And we've gotten to the point where it's likely that his stimulus plan, $1.9 trillion, it has already been approved by the House. It goes to the Senate this Friday and is likely to be approved then. And then we'll see the rollout of the largest fiscal stimulus in history. I've said in the past that we're not concerned about the impact on inflation. We think there's just way too much slack in the economy for inflation to take hold. We still believe in the Japanification story, and that we will see short-term cyclical bounces in growth and inflation, but long-term there's just too much debt. But US Treasuries hit 1.6% this in February, which certainly derailed markets a bit. We think this is good news. It certainly confirms that growth is going to be strong this year. However, it did lead to some major volatility in the tech sector. We saw Tesla giving up all its gains for the year. Gold is now down to nearly $1,700 a barrel. There have been losses on developed market bonds. We continue to stay away from gold, continue to not hold any gold or developed market bonds, and certainly haven't ever held any Bitcoin. But we think that there is going to be a lot of volatility in the sector as the US bonds and developed market bonds as a whole try to reflect the growth and inflation that's coming through this year. I don't think they're going to go much higher than they currently are, probably peaking at 2% on the US 10-year, but there's going to be a lot of volatility in getting to that place, and that volatility is going to drive switching from growth to value, and away from tech and back into tech as we get confirmation of that growth over the next 12 months. But generally, the US remains a very strong bullish case with the huge amounts of fiscal stimulus. The chart on the right just shows, and this is from Fairtree, showing the stimulus as a percentage of GDP across various countries. You can see that the US nearly 25% of GDP. It's just a massive amount of stimulus. Writing cash checks to every American citizen. It's just incredible. Next in line is Germany, and the third is Japan. But compared to the crisis over a decade ago, the great financial crisis between 2008 and 2010, you can see completely dwarfing the amount of fiscal stimulus that was rolled out at that time. Nearly 5 times the amount in the US alone. So this huge amount of stimulus is very positive for markets. Yes, it will lead to some inflation concerns, but we're not too concerned about inflation derailing markets. I do think valuations could derail markets, particularly in the US, and I'll talk to that later when we look at the US valuations. But I don't think that growth is going to derail them anytime soon. That's more likely just to lead to a rotation between from growth and value. China continues to march on ahead. We had the Chinese Lunar New Year over February. We've left the year of the rat behind. It's now the year of the ox, and they go from strength to strength. Some of the numbers that come out now are going to be distorted because of the movement in that new year from year to year on a calendar basis. But China continues to go from strength to strength. And certainly looking at their 5-year plan, while they were buoyed in 2020 by the huge fiscal stimulus and commodity drive, which led to very, very strong infrastructure growth within China, we're likely to see a continuation of that shift from infrastructure to consumption. Consumption, retail sales have continued to outpace infrastructure. We think that that's going to be the next leg that drives China and keeps their growth around the 5% level, which they are targeting. Probably 6% in 2021, but over the next 5 years, targeting 5%. And it's one of the reasons we remain bullish on emerging markets. However, there is a risk, there are always risks, and the risk that seems to be emerging within China is regulatory. They are quite focused on treating the fintech companies, Tencent and Naspers are directly impacted, Alibaba and Baidu and other companies, where they want to start to regulate them as banks and not fintechs, well, not technology companies, which, as you can imagine, banks are far more highly regulated than tech companies, and that would certainly lead to a lot more regulatory slowdown, red tape, potentially lower growth, maybe unearthing some corruption, certainly will add to a lot more volatility in that space as well. And while Biden hasn't got to in the US, it's certainly on his radar. It might be a month or two away, but certainly antitrust is going to lead to volatility within the tech space in the US. So not only are we going to see some headwinds from a potential growth to value rotation, but I think regulation is going to impact the tech sector globally quite strongly over 2021. But the emerging market recovery remains very strong, driven by an incredible commodity boom, which is a result of the fiscal stimulus and the corresponding manufacturing rebound. We have the largest global fiscal stimulus in 2 decades, a weak dollar, strong global trade. Copper has hit 10-year prices, 10-year highs. You can see the copper chart here on the right. All very bullish for commodities in emerging markets. One of the reasons why our resource sector was up 12% in February. And now there's also talk about the next global commodities super cycle, like we saw in the late 2000s. I'm not a fan of the super cycle theory. I don't think that commodities are in for another decade-long boom. I think that we have some supply shortages going on at the moment, which is positive for prices. We have certainly demand that is very strong as a result of the fiscal stimulus. The fiscal stimulus is a once-off event. It might take 12 or 18 months to roll out, but as soon as it's out, we then have the negative corresponding decline. There'll be a sudden drop off in that demand, and I think commodity prices, as supply comes back online and as the fiscal stimulus and certainly as China shifts from infrastructure to consumption, I think towards the end of this year, we could see some fall in commodity prices. But again, for 2021, commodity prices are looking strong, and that's a fall in those prices is a story for next year. So the third strong pillar remains in place. Looking within South Africa, we actually have seen, for a change, slightly more positive news than the negative news. Tito presented the budget, and as always, a poet at heart. He said, "Even though it is dark outside, the sun is shining behind the clouds." Once again, pointing to hope, once again, pointing to what can be done, the silver linings, what South Africa can achieve its potential. There's a lot of promises. but we are actually seeing a few more details come through, which is quite exciting. So looking within that, certainly South African bonds, as I've mentioned before, very attractive for investors because of the high yields, some of the highest yields in the world, and that is a result of the very high levels of debt. And that's where the budget was positive. There was an extra 100 billion in revenue that came through as a result of commodity prices. And again, that's something we've been talking about over the last 6 months now, saying that South Africa is a small, open economy driven by global growth, driven by commodity prices. And sometimes, despite our worst efforts, we can benefit. The rand touched 14.50, and certainly the commodity prices, iron ore, copper, platinum, have seen bumper earnings in commodity prices, bumper taxes, and that helped us have a slightly better budget with this extra 100 billion in revenue. So if you look at the charts on the right, the previous medium-term budget policy statement had debt to GDP peaking at 95.3%. In 2026, that's now falling, same time period, so debt still peaks in 2026, but it now peaks at 88.9%. So very positive that we are peaking at a lower debt to GDP ratio. It may delay further credit downgrades within South Africa, so that's fantastic. Of course, it's still an absolute number for an emerging market. 90% or 88.9% debt is still a very uncomfortable number for an emerging market. And certainly higher than a lot of our peers, and was one of the reasons why we have seen our credit downgraded. And the other risk that the credit agencies have been quick to point out is that a lot of that debt consolidation relies heavily on the 3-year wage freeze. And yes, last year's wage freeze was approved, so that's certainly looking positive, but the unions are going to put up a big fight to avoid a further 3-year wage freeze. And it was generally a positive, growth-friendly budget. We saw corporate tax cuts, which will take place in April 2022. That's a cut from about 1% of the corporate tax rate in a year's time. Tax brackets were moved up for personal income tax. It's the first time in 6 years we had some tax relief, which was fantastic, but all at the expense of reducing the government wage bill, which certainly needs to happen. I mean, it has grown completely out of kilter to the GDP of our country and to the private sector wage growth that needs to be addressed, but it's going to be a difficult fight. Hopefully we get even halfway there, because I think we will probably continue to have higher revenue come in and higher growth as a result of the commodity boom, at least over the next 12, 18 months. And that can allow for slightly higher wages, certainly below CPI, but above zero wages being negotiated between Treasury and the unions. So let's see what happens there. On SONA, President Cyril Ramaphosa also released quite a pleasing State of the Nation address with a lot more details than previously. Not just promises, but actual some concrete details. So he spoke about the renewable energy projects, which are already open for tender. We should see some of those closing within the next 3 months. At the same time, he spoke about reducing the admin burden for bringing on new projects, energy projects under the 50 megawatt range, and raising the self-generation threshold from 1 megawatt to higher levels. All three of those very, very positive for electricity generation within South Africa, and Eskom is certainly the key to growth. We need stable power. There's no way we can grow, there's no way we can create jobs without stable power. So at least those are three very positive things. They still have to happen. There are promises that will happen within weeks and months. So again, we've been watching closely to see if those happen, and there certainly could be some very positive catalysts for South Africa and South African growth. But we need stable power. We need to get load shedding behind us, and hopefully these details will assist. And then onto Regulation 28. We're expecting a draft in September last year. It was finally released late on Friday night with some interesting changes. So it certainly looks like there's this very strong focus on infrastructure without infrastructure being a prescribed asset. However, what they've done is they've added in a definition of infrastructure. Infrastructure was never part of Regulation 28 as an asset class. And they've also added in a limit. So up to now, you could have effectively, depending on the definition of infrastructure, you could have 100% with an infrastructure because there was no specific limit. We're now limiting it to 45%. So you might think, well, that's odd. Why, if you want to encourage infrastructure, are they adding in a definition and then limiting it? I think it's all about self-regulation. So I think the point of this is to, the moment you define something in Reg 28, you have to report on it. So every month when you have Reg 28 reports that are sent out to pension fund trustees, it'll give your infrastructure exposure relative to that limit. And it's going to empower trustees to say, oh, well, we've only got 3% infrastructure out of our 45%. Why do we only have 3%? Why are we only supporting our own country up to 3%? And it's going to allow trustees to drive that infrastructure level to a number that they think is comfortable. We're not sure what that level is, and we're not sure what the definitions are of infrastructure, but they may want 5% or even 10%. But we should see a lot more demand coming from the trustees, and I think that is the way that the partnership between pension funds and government want to take this forward, is to have not prescribed assets, but to have the trustees drive that allocation to a level that they think is suitable, and certainly having it classified as a separate asset class and having it reporting on a monthly basis will empower trustees to do that. At the same time, hedge funds and private equity were split up into separate asset classes, hedge funds with a 10% limit and private equity with a 15% limit. Again, that limit seems rather obscure. I think the average private equity allocation to pension funds in South Africa is about 3 or 3.5%. We're way away from 15%. So moving that limit or separating those limits is not urgent, but it does allow a higher allocation if you want. We still believe that for a pension fund, better to get the bulk of your exposure on the debt side, private debt. Most of these are long-term projects, 15, 20, 25-year projects. We're talking water infrastructure, we're talking toll roads. Those are the sort of stable utilities where you put up cash and you collect your income and your coupon steadily over the next 20 years. Much more suited to debt than it is to equity. Yes, certainly there is an equity component during the construction phase, but it's by far the smaller component. So in general, we're quite a bullish, well, more bullish than usual month for South Africa, with some potential catalysts on the horizon. Certainly, the budget was positive, and the debt is lower than it was. Taxes are lower than they were, both of which is growth positive. The State of the Nation had some strong details about energy generation, which is growth positive, and Regulation 28 is going to help drive infrastructure, which is certainly going to be very good for South African growth. It's like World Cup 2010 all over again, except actually we're building some real assets, not some white elephants, which is great. And then further growth positive is our move to lockdown level 1, which is really good to get things going. And we've rolled out, I think, by the end of February, was 63,000 Johnson & Johnson vaccine doses. So not quite the levels of Israel yet, but at least we're making a start, and quite excited that that's firmly moving on. And we had yesterday saw the second round of J&J vaccines arriving in South Africa. So we've now got 160,000 doses, and hopefully those will be rolled out quite soon. But in general, while we stay bullish on South African bonds because of the high yields, we remain cautious on South African equities. We have reduced our underweight. We're only underweight 1% now on South African equities, so we're getting closer and closer to neutral, but we're still waiting for decent catalysts to come out, particularly on the Eskom side. So if we see some of these administrative burdens being properly sorted out from a regulatory perspective, we may use that as a strong catalyst to go neutral or even overweight South African equities. Okay, so the question that I've had asked and I'd like to answer more on a thematic basis, is where to stash your cash in a low return environment. Now, you may think it's strange to talk about a low return environment when markets are up 30% over the last 3 months. I mean, certainly 30% is not a low return. I mean, that's what we've been predicting over a 3-year return from equities. So it's been a fantastic 3 months. And to the end of February, we've got balance funds up 20% over 1 year. And that is a great return. But over 3 years, returns are still single digits. And we believe that that's going to stay in place. We firmly believe in the Japanification roadmap as the best roadmap for the next decade. And Japan's equity market has doubled over the last 30 years and then halved. So volatility is the name of the game. And while growth is constrained by debt, you are going to have these short-term 1 or 2 year bounces, strong cyclical growth coming through, the fear of inflation coming through, equities rallying, but then the reality and the huge amounts of debt come back to front of mind, and deflation then becomes the concern, and the cycle continues. So why do we believe in low returns over the next decade? Well, four reasons. The first is high valuations. Towards the early 1980s, we had interest rates in the US over 10%. They now, well, they got down to zero. They're now up to 1.5%, but still, the huge free lunch we had over the last 30 years of the cost of money effectively falling from 10% to zero, and that reflating every asset class, whether it was gold, bonds, equities, property. That free lunch is unfortunately behind us, and at best, we're going to see interest rates move sideways, and at worst, we're going to have months like we're going through or now with interest rates rising, and that puts a dampener on gold and bonds, and can actually lead to equities falling if earnings aren't growing fast enough. But I think this year we do have earnings growing quite fast. So even though there won't be a re-rating on equities, the earnings should help keep certain sectors of the equity market rising, certainly not all sectors. The second is high debt, and spoken about this many times, but we managed to scrape out of 3 crises of the last decade: the great financial crisis of 2008, Brexit in 2011, the European peripheral countries and their debt crisis, with the Chinese shadow debt crisis in 2015, and most recently we've had the COVID recession. We've managed to scrape out of all of those crises by just taking on more debt, by kicking the can down the road, and we now have the highest levels of debt to GDP in history. And that's certainly, all we're doing is stealing from the future and bringing that back now. So while that helps fill the gap and prevents us from going into a depression in 2021, at some point we have to address that debt. And when we do, it'll slow growth at that point. So it's just smoothing things out and avoiding hell now, but insisting that we stick in purgatory over the next decade. Aging demographics has been a big concern of ours for the last 5 years, and it remains a big concern. Growth is a result of productivity and the number of people working. And when you have more people retiring than entering the labor force, and you have shrinking labor force numbers, which we have seen in Japan for the last 20 years, Europe for the last 5 years, China's at that point, the US is getting to that point within 5 years. Certainly, that constrains your growth. And when you have such high levels of growth, it's difficult to grow out of that debt with aging demographics. We managed to grow out of World War II debt because we had huge growth in the labor force, because we had emerging markets into the labor force, we had women into the labor force, we had Social Security allowing both parents to work. It was a fantastic growth period. Now we're stuck with that huge debt and a very little tailwinds to help grow. And fourth is productivity, where we don't see or we haven't seen the same levels of productivity over the last decade that we did over the 80s and 90s and 2000s. So we still believe that Japan, or the Japanification, is the best roadmap. This is This chart shows what happened to Japan over the 23 years since it started quantitative easing in 1997. They've taken their debt to GDP to 230%. It's the highest debt to GDP in the world. They've taken the QE is now 115% of GDP. Bank of Japan owns nearly 50% of all government debt, so that they've really they've done everything they can, and they're way ahead of Europe, New Zealand, Australia, Canada, England, and US when it comes to quantitative easing. And yet, look at the success. Bond yields have continued to fall. That's the green line as inflation doesn't come back. The yellow line is nominal GDP. So that's inflation plus real growth, which means it's both number of people entering the labor force and productivity. All of that has been flat over the last 23 years. The stock market is certainly at least up over that time period slightly, but huge volatility in that period. So we think this is our best roadmap. And what that means is lower growth, high volatility, and how do you survive in that period? Well, it's acknowledging that while equities are still necessary, it's still going to give you a highest return out of any asset class. The equity return is going to be a lot lower than it was in the past because equities are linked to growth. Bonds and cash, yes, will still give you returns. They may be slightly lower than they were over the past because interest rates are lower, but it's not as big. Equities will give you a substantially lower return over the next decade. And that means that when you see the volatility take place, you're going to see negative returns on your investment far more frequently than you had in the past. So you need to be aware of that. Equities need to be there, but with the volatility and low returns, you're going to have a lot more negative drawdowns in your portfolio than you had before. So keys to surviving a low return environment, 4 factors. The first is smoothing out the volatility of your portfolios. So if you have a life staging portfolio, or if you are planning for any sort of saving for any event, whether it be education or a holiday or retirement, you need to start moving out of high risk, high volatility into low risk, low volatility asset classes sooner than you have over the last 30 years, because you need to smooth out that volatility. Then you need to keep costs down. We've spoken about this many times at Sygnia, but in a low return environment, costs are vitally important. It's the one thing you can control, and if you reduce your cost by 2% per annum over 40 years, that leads to a massive increase in your retirement benefit. So as a result, passive has won the debate. It's not a question of passive or active, it's just how much passive you want. You might want 100% passive, or you might only want 10% passive, but you have to have some passive just to keep the costs down so that overall costs don't eat your returns as much. Third point is tactical asset allocation. We've spoken about this also many times. It's about managing risk with the huge amounts of volatility that we have seen. There's far more opportunity to be tactical, but there's also far more need to be tactical to add additional alpha because of the low return environment. And that's something that we do in all our balanced funds. We use TAA to manage risk from a top-down level and harness that volatility. And lastly, over a decade outlook, you need to look at diversified sources of global growth. So sectors that, despite a slowing growth world, will still see growth due to growing market caps. And that's, for example, our Fourth Industrial Revolution Fund or venture capital funds that focus on growth sectors. For 2021, it's a different story. For 2021, when the whole world is growing due to the huge amount of stimulus, you can actually look on the growth side at a far broader range. But over a longer time period, a decade in line with Japanification, you do need these alternative sources of growth. So, answering the question of where to stash your cash, and this is a difficult question. So while we remain bullish over 2021 for markets, markets have run incredibly hard, and in particular the US. Since the March lows of the COVID recession, S&P is up 75%. That's the strongest bull market since the lows of 1932, where markets ran 78%. So it's another 3%, and it will be the strongest bounce from the lows in history. So when we see runs like that, we certainly need to take a step back and wonder, sure, has the market run too hard? And certainly the US looks like valuations are looking stretched. The chart on the right there shows the Schiller Cape for the S&P 500. This is the best predictor for returns over the next decade. And you can see based on this basically smoothed price to earnings basis, shares are as expensive as they were in 1929. They did get slightly higher at Y2K 1999, but looking further back, you can see nearly 100-year highs on the PE valuations for the US stock market. Another measure to look at is Buffett's market cap to GDP ratio. If you look at that, that would suggest that returns over the next decade from the S&P would be minus 10% per annum in nominal basis. Certainly something that's very, very scary. We're not predicting that at all. We don't think that that's the case. I mean, there are certainly dislocations between GDP and the financial markets, as we see a larger multiplier take place with more financial instruments. But if you look at, and also we've got really low interest rates. So if you look at the very low interest rates and the low bond yields as a proxy, well, then you can sort of justify the higher valuations, but not to a large extent. So if you take some combination of various indicators, you're probably looking at a 2% real return from US, the S&P 500 over the next decade. So 2% return, better than bonds in real terms, which, I mean, bonds might give you 0.5% real return in the US. So you're looking at an extra 1.5% real from the S&P 500 relative to US bonds. But in a global sense, that's not looking very exciting. For the huge amounts of volatility you take on to be exposed to equities, we still think that that there are better returns from other parts of the equity market. We remain underweight the US. We don't have no exposure. We remain underweight on our global portfolios. We are about 10% underweight the US. If you look at global equities being on 100%, we're about 10% underweight the US, and we have that allocated to emerging markets, which we think still are a very strong growth region. Europe, which has underperformed the US quite substantially because it doesn't have as much tech. Japan, which has also underperformed the US. We've got much smaller exposures to Europe and Japan, but we still are overweight those regions. And then we have our thematic exposures: healthcare, property, fourth industrial revolution, which we also think over the next decade will grow quite nicely. So where to stash your cash when you're looking at a low return environment, particularly when the US is looking so expensive? Well, it depends what you need. So if your concern is the search for yield, and if you want conservative returns and you have a short-term time frame, well, then the best thing to do is the Sygnia zero management fee unit trust. And I've spoken about that before. We've got the Sygnia money market unit trust, which for the next 2 years, just under 2 years, has 0% management fee. And we have the Sygnia all bond unit trust, which again for the next 2 years has got 0 management fee. Those are great opportunities for low risk search for yield. The money market unit trust is giving you about 4.3% return, gross or net, because they're now almost the same. That's fantastic. And that's definitely better than putting your money in the bank with a more diversified return and very similar liquidity. Your liquidity is 24-hour notice period, 48 hours if you're on the list platform. So it's quick access to that money with greater yields than putting in the bank. Then looking at the all bond unit trust, we do think that we are overweight South African bonds, as I've said, due to the very high yield. Yes, there is more risk there because of our high debt levels, which is what's allowing us the opportunity to get these high yields. But when you look at over 9% return for additional volatility, if you can afford that slightly longer time frame, then that's a great yield play. For those looking for global growth diversification over the long term, we've got some great thematic investments that are seeing tailwinds, and will continue to see tailwinds over the next decade. Fourth Industrial Revolution, as it identifies new technologies that come to the market. The Health Innovation Fund, which will benefit from aging populations and the COVID R&D spend. Both great investments when the rand strengthens. Right now, the rand's slightly weaker, back to the 15 level due to the risk off that we've seen because of high bond yields. But when the rand does strengthen again to 14.5, it's a good opportunity to get exposure to some of the global growth investments. Fourth Industrial Revolution has run very hard. And we do have a larger overweight in healthcare, which hasn't unfortunately run as hard and is down year to date in dollar terms. But we strongly believe that over the very long term, they're both very good investments. Then, if you're looking at shorter term, not shorter term, but sort of a medium term investment, and you want to get exposure to the reflation story that's taking place, then you can look at emerging markets. We are overweight emerging markets. Yes, these are equity investments, so it is high risk. This might be a 5-year story, not a 10-year story. We also have the Sygnia Equity Unit Trust. As I said, we are underweight South African equities. We're getting very close to the point of being neutral and taking that overweight. And we have just cut the base fee. There should be a letter coming out today or tomorrow. More great news. So along with our zero management fee money market unit trust and zero management fee bond unit trust, we are cutting the base fee on our equity unit trust by nearly half. So that's going from 90 basis points to 50 basis points. That is a great opportunity when you are ready and we are ready to invest in South African equities. South African equities certainly are showing more value than they have in the last 100 years, even though they have rallied a bit from their lows. We think that there is a lot of value. We don't want to be too early, but I think we're getting closer and closer to that inflection point. And that is a wrap for where to stash your cash. So I'm going to stop sharing my screen and look for some questions. We look at the Q&A. Oh, so there's a question on the upcoming ETFs. Sygnia is planning to launch this year. So I was hoping that we'd already have some of them launched, but the regulatory approval takes longer than I would have liked. But we should have coming up in April, we should see the launch of our emerging market 50 ETF. We think this is a great opportunity to get exposure to the growth sector. We do think that emerging markets are going to be see growth tailwinds over the next decade, as particularly Asia emerging market, that region sees high growth due to its growing middle class. And so that will be available in April of this year. Also very low TER. I think it'll be one of the cheapest emerging market exposures you can get, with 3/4 of that exposure to Asia, 50% China, 35% rest of Asia ex-China, 15% to Brazil, India, Russia, and a minuscule amount to South Africa. Then the following month of May, we should see the launch of our ESG ETF. That is the S&P 1200 ESG. Very exciting for people who want to switch into an ESG index. Also, again, at very competitive fees. I think, again, it's going to be the lowest global ESG ETF available in South Africa. And then in June, we're expecting the launch of our healthcare ETF. So that will be the equivalent of our Health Innovation Unit Trust that is available. And that will be out in June. Then at the same time, we are applying as we speak for further ETFs. We don't have a deadline on that. As I said, some of these regulatory approvals take longer than we'd like. But the next ETF that we're working on is a China ETF, particularly China tech focus. Some of you may have received a survey in terms of exactly how much you prefer to look at China tech versus China ESG. We are certainly leaning towards the innovation side ourselves, looking at healthcare innovation and consumer innovation and tech innovation. So that's likely to be the bias of that ETF. And then post that, probably, or maybe at the same time, we'd like to launch a value ETF. It's always good to be able to balance. I mean, a lot of our ETFs are growth focused, but when you do have inflation rising and cyclically, like we're seeing now, it's always good to balance some of that growth with value. And then the sixth ETF we're looking to launch, and that's more uncertain in terms of its timing, is a crypto ETF. As again, that's very much dependent on regulatory approval. It's something that the JSE has turned us down before. We did try to launch a crypto debenture 3 years ago, and we were turned down. But now that the S&P is working very hard to get this listed, we've seen Canada launch a crypto ETF. Certainly, there's a lot more pressure and precedent in place, and we're again in negotiations with the JSE to try and get a crypto or Bitcoin ETF launched. That's something that I'm not as excited about. I don't plan on putting any of that in the funds. But for those of you who like the very high risk investments, it will be available for you. And at least it will be safer from a regulatory perspective. A lot of the credit risk will be removed, and you won't have people running away with your wallets. But I think that we are likely to see a lot of volatility continuing in that space. Yeah, a question on the Health Innovation Fund. Yes, and we are disappointed with that. That's down in dollar terms, down 6% from the start of the year. But the same thing when we launched FANG, and more recently that FANG was launched about 3 years ago, and we had the tech crunch literally the same month. It was launched in August, and it was down 20%. And since then, we've seen the FANG performance has been phenomenal. So we do think that those long-term structural tailwinds remain in place, that we're with aging populations and advancements in healthcare, and certainly rising LSMs means that people will have more money to spend on healthcare. All very strong structural tailwinds. It remains our biggest overweight in our global portfolios, the health innovation. And we think this remains a good entrance point. Unfortunately, it seems to happen each month. I'm not quite sure what that catalyst is going to be, but we do think that's structurally a very good long-term investment. Unfortunately, there wasn't any feedback in the budget speech. The Treasury did say that they were going to give feedback on the SARB draft tax directive, directive, which was going to allow or treat ETFs as being inward listed. We haven't had any feedback on that yet. There was a rather strange reference in Annex F, which has a bit worried, which looks like they might be going the other way on this, but we haven't had feedback on that yet. So we're watching that space, and we are engaging with SARB, and as soon as we have clarity, we'll let you know what's happening there. A question on EMX SOEs. So yes, that is one of the concerns about China. China makes up 50% of the our EM ETF, and we do really think that China is particularly, well, all of emerging market Asia is a good structural investment over the next decade. There are some concerns about the reliability of the SOE data of the listed SOE companies within China, and that's one of the reasons why our China ETF in particular will be focusing on either tech or tech innovation with an ESG overlay, either of which reduce the SOE exposure. It's a question on tactical asset allocation, which we use to manage risk. Tactical asset allocation is basically our, if you want to call it, smart rebalancing. Unfortunately, when you blend different asset classes, there is no way to passively rebalance. You have to either pick a random point in time, like end of month or end of quarter, or you do it in a constructive manner. And you take a view on each asset class and you say, okay, well, we think that although equities are expensive, there's very strong growth and lots of managed support. So we're not going to bring that back to neutral. We're going to stay overweight for a while, or similarly, if markets fall and you're underweight, rather than automatically rebalance, if you think that there's a lot of risk, or you stay underweight. Similarly, on the global side, it's our ability to move out of expensive, or at least reduce the exposure to expensive areas where the return is not worth the risk, and that's something we certainly think of in the US at the moment. You look at the risk-return relationship, we think risk in the US or volatility remains high, but the future returns are low. So that ratio between risk and return that allows us to protect the portfolio from taking on risk that does not reward the return. No, I'm not invested in Bitcoin. I wish I was. This coin that you can see here is the Sygnia fee-saving coin. It's not a Bitcoin. I don't own any Bitcoin. I take the Berkshire Hathaway and Warren Buffett and view that is just too risky. I also don't take the lotto, but if you like the lotto, then I think Bitcoin is something that, or if you like going to the casino and you enjoy gambling, well, then I think Bitcoin is for you. But I certainly don't invest in it. South African property stocks, when do you think they're going to recover? That is a very tough one. As I've said, it looks like there's some very decent yields, but right now, I'd much rather take a 9% or 9.5% bond yield. I think there's 10% in our enhanced bond fund versus 11 or 12% yield in property. There's just still too much structural headwind, too much oversupply in South Africa. South Africa had an issue with property, and we were underweight property before COVID hit. There were a lot of imbalances. We sold out of South African property 3 years ago, and COVID has just made that even worse. So we think that it's still too soon to get into South African property, and we would rather stay in South African bonds. We may get to a point if South African bond yields rally strongly that we force to take on some property just to get the additional yield, but right now it's easier just to get yield on credit. Looking at the FANG fund, we removed our overweight exposure to FANG some months ago. We were concerned that that was looking quite stretched, and we moved that, rotated that exposure into the fourth industrial revolution, which was looking a lot cheaper at the time. But since then, some of the FANG companies have fallen, some of the fourth industrial revolution companies have risen, and they're now both looking expensive, but neither of them are as expensive as they were. So we still have small overweights to both of them, but they are very small overweights. I still think there's a lot of volatility there, a lot of risk there, whether it's regulatory or valuation driven. I think that in the short term, we've kept our overweight pretty small. Structurally, over the long term, we do think that it is a great place to be, but we're waiting for better entry points into both those portfolios. FANG, and ETF, waiting for better entry points to take it from a small overweight, very small overweight, to a large overweight. Yeah, as I've said on the question on the 45% cap on infrastructure, it really depends on how that's defined. So it's all very convoluted. The changes in Reg 28 references the Schedule 1 or Schedule 7 in a 2013 infrastructure document, which then references a table in the infrastructure plan, but it doesn't say which plan. It could be the 2020 plan. There's a 2003 plan. So it's a draft directive. There's lots of questions that we are putting together and compiling that we will send into SARB on that. So it depends on how they define infrastructure. Infrastructure could be, effectively South African bonds are used to fund infrastructure. So does South African bonds make up 45%? Or do state-owned entity bonds, so if you invest in Eskom bonds, does that contribute infrastructure? Because certainly Eskom is our electricity infrastructure, or SANROL bonds, do they include infrastructure, or is it just the projects? So it's only specific projects, and there's no look through within SOEs or within governments. So we need to define exactly what infrastructure means, and only once we know what that means, well, then we can look at the 45% limit. Certainly, if it's only the project level, then I think 45% is a very high limit, and we won't get close to that. We might get to 10%, or maybe only 5%. Because projects are not diversified. You're looking at one project. Yes, you can get a basket of projects, but to start off with, this is going to roll out over time, and there aren't that many projects available. You might be able to get a portfolio of 10 projects if you're lucky, but that's still quite a concentrated view. So yeah, a lot more questions, but at least the draft is out, and we can, we'll submit our comments by the 29th of March, and hopefully it doesn't take too long for the final version to come out. Oh, good question. Why is the skeleton balance fund not on a stash or cash slide? And it certainly should be. So that's a very good question. Certainly, if you don't want to worry about making a call about whether you want bonds, which we are overweight, or whether you want healthcare globally, which you are overweight, or if you want various allocations, and you don't want to do your own tactical allocation, then yes, the skeleton balanced funds, or the signature balanced funds, or the skeleton balanced funds are all on our stash or cash slide. That's certainly probably the best place to be. That's the default. You choose your risk level. Do you want high risk? Do you want low risk? And we take care of everything. We worry about how much you should put in bonds, how much you should put into healthcare, how much you should put into fourth industrial revolution, how much you should put into FANG, how much you should put into South African equities, and we blend that risk so you always have the optimum risk return framework. And the fees on that product are just phenomenal. 35 basis points plus VAT, and that's direct. Or you can go into an RA, and there you're looking at platform fees, RA wrapper fees, and the management fees, all for 35 basis points. Basically, the wrapper and the platform are free, so you're getting all of that for 35 basis points, and we take on everything. So all you really need to do is decide which risk level you want, which is mostly linked to your time horizon. If you've got a very long time horizon, you can invest in the 70 fund, which is 70% equities. If you've got a shorter time horizon, then you want to be on the lower side, 40% equities. You pay a very low fee, and we manage everything for you. And certainly, if you compare that to some of our competitors who charge you for the platform, they charge you for the wrapper, they charge you management fees, it's an absolute no-brainer. Because it's available in a variety of wrappers, you can switch your RA into that, or you can switch your unit trust into that, or your preservation fund can be switched into it. It's really low return environment. It is our 4 key success factors that we spoke about. All of those are wrapped into the skeleton balance fund. Low cost, harnessing volatility, blending some of the long-term diversified global growth with some of the low risk, high yield opportunities. So yes, please do look at that. That should have been on that stash or cash. And certainly, I would put that before any of the other ones, unless you want very high risk, high octane risk, or then you can go for the equity only funds, the fourth IR, the health innovation, emerging markets, or the equity unit trust. Or if you want very low risk, then you go for the money market unit trust or the bond unit trust. But if you want any sort of risk in between, high octane and very conservative, you want some sort of balanced, then go into our balanced funds. Skeleton balanced is the unit trust, skeletons on the life side, or signature if you want some active equity and bond managers in there, if you do like some active. And unfortunately, that's all the time we have for today. So I'm going to say farewell and thank you so much for listening in. I'm very sorry for the questions I didn't get to answer. I will try and get to them by for the webinar next month. But thank you very much. Our monthly market outlook, which is signals, which is basically a summary of this webinar without obviously the Q&A. That normally goes out on the first working day of the month. There were some technical glitches, so that will go out today. So please look out for that. If you aren't receiving it, please let us know and we'll add you to the distribution list. But that gives a very nice summary of what markets have done, what we think markets will do, and how we're positioning the funds accordingly. Otherwise, have a great March. All the best for the markets, and stay safe. Cheers.